There is a specific kind of pain reserved for looking at a balance sheet that is unnecessarily fat. You look at the assets. Deferred Tax Asset, $50 million. You look at the liabilities. Deferred Tax Liability, $50 million. Any rational human being would say, "Boss, that's zero. Let's just wipe them both off and go to lunch." But no. The auditors scream, the standard setters hyperventilate. They insist you keep both numbers massive and separate. You end up with a balance sheet that looks like it's on steroids, showing huge numbers that theoretically cancel each other out just because IAS 12 has trust issues. It makes your company look leverage heavy and asset bloated at the same time. It is the accounting equivalent of wearing shoulder pads to look bigger. To understand why you cannot just net these off, you need to understand the concept of different pockets. Imagine you are at a family reunion. Cousin Vinnie, the liability, you owe Vinnie $500 because you lost a bet on the Super Bowl. He is standing there with a baseball bat. He wants his money now. Aunt Marie, the asset. Aunt Marie loves you. She has promised to give you $500 for your birthday next week. The offsetting fallacy. You turn to Cousin Vinnie and say, "Hey Vinnie, Aunt Marie owes me $500. Go ask her for it. We're square, right?" The result, Vinnie will break your kneecaps. Why? Because Vinnie does not care about Aunt Marie. They are not the same person. They do not share a wallet. Vinnie cannot legally force Marie to pay him. Your asset cannot be used to settle your liability unless they agree to it. Unless Vinnie and Marie are married and share a bank account, you are still in trouble. IAS 12 is basically Cousin Vinnie. It says you can only offset tax assets and liabilities if you meet very strict criteria. You cannot just mix and match tax bills from different places. Rule 1. The legal right. The Vinnie check. You must have a legally enforceable right to set off current tax assets against current tax liabilities. Rule 2. The geography trap. The France versus Germany problem. You generally cannot offset taxes from different jurisdictions. You have a huge tax asset in Germany and a huge tax liability in France. The French government does not care about your German refund. If you tell France, "Don't worry, Germany is paying me," France will seize your bank account. You must show the German asset and the French liability separately. You cannot net them to zero. Rule 3. Same tax authority, different entity. The group problem. Even if both companies are in the same country, you can only offset if there is a tax sharing agreement. If subsidiary A owes tax and subsidiary B has a refund, but they file separate returns, no offsetting. Subsidiary A has to write a check and subsidiary B has to wait for a check. Here is the bottom line for your financial statements. Netting is a privilege, not a right. If you net off assets and liabilities that should not be netted, you are lying to your investors about your liquidity. You are telling them, "Don't worry, we don't need cash to pay this tax bill. The refund covers it." But if that refund is stuck in a bureaucratic black hole in Brazil and the bill is due tomorrow in New York, you do need cash.